Hey everyone, we got some huge news for FSLY stock investors. So in this video, I'm going to review those latest developments and what it could mean for FSLY stock investors or those interested in FSLY stock. So without further ado, let's jump in and let's take a look at these details.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, FSLY informing investors that revenue in the fourth quarter increased by 15% to 138 million. That was at the lower end of their guidance where they forecasted between 137 and 141 million in revenue. This was more troubling because FSLY has the reputation of exceeding expectations, and given that they went on the bottom end of their range, that was a little bit disappointing. For the full year 2023, they beat expectations in revenue. They exceeded their top end of their guidance, but for the fourth quarter specifically, they were below the midpoint of their guidance, not by very much, but still investors were expecting the company to exceed expectations here. Additionally, fourth quarter remaining performance obligations was 245 million. That was down 1% from 248 million in the third quarter of 2023 and up 24% from the fourth quarter of 2022. So year over year, it was up, but from the previous quarter, it was down. And the more important metric here is from the previous quarter, since remaining performance obligations is a cumulative measure. And so it's more important to look at where it was from the previous quarter. This means that the company didn't generate enough new sales to compensate for the existing sales that it delivered on in the quarter. Remember, remaining performance obligations is eventually going to turn into revenue as the company performs these obligations that it has contracted to perform. And so if the remaining performance obligations is decreasing, it signals that revenue could be decreasing or revenue growth could be decreasing. So the company changed some of how it sells its product. Its consumption-based revenue model is now being augmented with predictable revenue packages. We believe that RPO will become a more meaningful indicator to the health of their business in 2024. So they're trying to supplement their consumption-based revenue model with more predictable revenue packages. The difference between these is the consumption-based revenue model tells its companies, its clients, that you'll pay for what you consume. So there are no minimums, no requirements, no monthly fees. Just if you consume 100 units of our product, this is what your bill will be for that month. If you consume 50 units, this is what your bill will be. It can fluctuate up and down. There is no minimum. There is no monthly requirement. There's no fixed contract with the clients. Whereas the predictable revenue package is more fixed in nature. As it states, it says every month you'll pay us 100 million, regardless whether you consume 100 units or 50 units, your fee, your price will be 100 million. That's a more predictable revenue source because FSLY will know every month this customer will pay us 100 million versus the consumption based. They don't know how much consumption that client will use up in that month. So that's more volatile and uncertain for FSLY. As a business, you'd always prefer more predictable revenue in nature. And when you're paying for something, you'd prefer usually the consumption based because then you can go up and down without worrying about your fee is going to be the same whether you increase or decrease your usage. So their trailing 12-month net revenue retention rate was 113%, down from 114% from the prior quarter and 119% in the year ago quarter. So this metric is moving downward. So let's understand what net revenue retention rate is. This measures how much a company spends with you after they've been with you for at least a year. So it signals over 100% says that this company is spending more with you this year than they did last year. And it's an indication that they see good return on investment with their allocation with you as a company. And think about yourself as a customer. If you go somewhere and you spend money with a business and you realize, man, this is good value. I want to come back here and I want to spend more money with this place. you'll go back and you'll spend more money with that place. Versus if you go somewhere and you spend money and you feel like, man, they overcharged me for what I was getting in return, you'll decrease your spending and you'll say to yourself, I don't want to go here as often because they're just too expensive for what I'm getting. And that's not so much different than what's happening with Fastly and their net revenue retention rate. If customers are seeing they're getting good value, they'll say to themselves, let's go with Fastly more often. Let's spend more with Fastly for the service that they offer. While it is at over 100%, it's a little bit troubling that the trend is moving downward, in that their rate of increase is decreasing from 119 to 114 to 113. That's not great news here. And then annually, if you look at the annual net revenue retention, it was at 99.2% versus 98.9%. So this is less than 100%, although this is moving in the right direction. It's moving higher. On the positive side, the company did a good job controlling their variable costs, especially with lower transit costs, with successful renegotiation of their transit rate in several international markets. So let's look past all this jargon here with transit cost and all of these other things that they're talking about. Ultimately, the core of this, the fundamental aspect of this, is that as their revenue is growing, they're exercising better negotiating power, right? That's what I like to see with these smaller growth companies. As they increase their revenue, I want to see them generating some negotiating power, some pricing power, where they can go to their suppliers and say, look, now we're generating more revenue. We're spending more with you. And because we're spending more with you, we want you to decrease the per unit cost, right? If you're spending $100 with a certain provider, they'll charge you a certain price per unit. But if you now increase your spending every month to $100 to $500 from 100, you should be able to get a lower price per unit because you're now spending more with this provider. And so they can offer you a better per unit price because now you're spending more with them, and they like that too because now they get more money from an existing customer. They don't have to go around several different customers to generate the same amount of revenue, and they can generate more revenue from one customer. And so it's a win-win situation for both parties because you're spending more with them so they can get more from one customer, and their cost to serve you is lower than if they are serving 5 different customers, and you're generating a lower price per unit. So it's a win-win. I like to see this from companies, and it's a good sign that Fastly is demonstrating this with their variable costs. And then finally, more good news is that while they've made significant gains in their cost of sales, there's still room for further reduction. That's great news here because not only have they improved their variable cost ratios, but they're signaling that there's more room to go, meaning that they've identified areas where they can see that they're going to lower the cost. It's just going to take a little bit more time for them to actually execute on that improvement. But they see it, they know what they need to do, and now it's time for them to actually do it. And then in the next 1 or 2 or 3 quarters, they should come back to investors and say, look, we told you we had room to further decrease our cost. Here's what we did, and here's how much we lowered our cost. So more good news here for Fastly in terms of their cost of per unit sales. So they're improving profitability, which they have demonstrated improving margins. They're still losing money in terms of operating costs, operating profit margin, but that has been improving, and management here noting that it's likely to continue improving going forward. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.